I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has now been in business for 55 years, dating back to 1970. Uh, Brad, um, it's going to be in the single digits here in the next few days here in Vermont. Although there are worse problems to have out there weather-wise. I'm always curious this time of year. What is the coldest it gets in Arizona, or at least where you are in Arizona?
We get below freezing overnight. So like right
Okay.
now it's like 50 out.
All right.
But
That's
then
not too bad.
overnight, every once in a while we'll get down below freezing. But that's about as bad as it gets.
No, that's why people live there, I guess. They
Well,
can
so
tolerate
that
the 100-degree, 120-degree
yeah,
summer.
that's where I am now. We're in the Phoenix area. If you go up north, you get snow and cold and sub-zero temperatures periodically, stuff like that. So it's like you can get it if you want it. Having lived there for a while, it's best in small doses. I don't know that I'd want to do the Vermont thing.
Yeah, January, February is take your medicine months in Vermont. Yeah, you'll just in the 20s is like a baseline, like you're fine. That you're just used to that. But you'll get weeks of single digits below zero, and we're gonna get that. I think wind chill is supposed to be below zero Monday through Wednesday next week. We were gonna go skiing on MLK Day, but that's out the window. I can't do that when it's 2 degrees and probably 20 below with the wind. So yeah, I'm out.
Yeah, it sounds like a nightmare.
It does. Yeah, and I'm my born in Vir or grew up in Virginia blood. I can't take that. I'm delicate as it is. So, anyway, that's weather talk. That was specifically for Jacob, who loves weather talk on Street Check. Jacob Mintz, our colleague. All right, tell people what we're gonna talk about investing wise today.
So it's a little bit light on the news front this week, but it's sort of a transition period, right? Like our bull market seems to be back in effect. This week we're going to talk about the cooler inflation print that seems to be behind a lot of that, stemming the bleeding from the little December correction we had. We are going to talk about bank earnings. We've got some early indications from a couple of names there. And then we'll talk a little bit about Trump being set to take office and what that might mean for the market. And then in our main segment, we are going to highlight some earnings season hotspots we're watching going into first quarter 2025 earnings. Before we get there, though, we will start, as always, with Defend the Take. This week, Chris is up. And Chris, your take, Treasury yields below 4.5%. It's a green light for stocks. You have 90 seconds and you may begin.
Yeah, so this is a little bit of an imperfect science, but 4.5% has kind of seemed like the magic number here. Stocks have had a rough December and January, month and a half now, and the yield has mostly been above 4.5% during that time. In fact, it was December 6th was when the last time it was below 4.5%. And that, not coincidentally, was the market peak. And stocks have been down ever since. Here are some stats for you. So from June through mid-December, or first week of December of last year, the yield was below 4.5% almost the entire time. S&P was up 15% during that time. Last April and May, when the yield was mostly above 4.5%, S&P was flat. And in the past month and a half, month plus, S&P is down about 2% with the yield above 4.5%. There's exceptions. Yields were mostly in the 4.1 to 4.2% range last July and August, which was the biggest dip during this bull market. But they were also on the rise. A lot of this is direction of yields. When yields are up, markets don't like that these days. And so when yields spiked after the jobs report, the troubling jobs report in late July, and Fed still hadn't cut rates at all. People were getting antsy. Market didn't like
Time.
that, but 4.5% in general is the magic number. And I just gave you the stats. Right now, it's at 4.6%. By the way, so it's down from 4.8 a week ago or beginning of this week. And we're going to get into the reasons why it's down, but. we're not quite below the 4.5% threshold.
Yeah, I like it. I think I think you're broadly right on it. It's a influential sentiment measure, cost of capital measure, like, but it's not a the bond market has always been looked at sort of as the smart money, like because
Mhm.
retail isn't there. It's all retail is in the stock market. They're not trading bonds. So bonds, even Wall Street looks at the bond market as the smart money. Um, so it is, I think, a great big picture thing. But like you highlighted, a week or two of yields moving can move the market, but it's not reversing trends or flipping us to bear markets, or at least it hasn't thus far in the last 2 years.
Yeah, and if you know, if you're wanting to just simplify things and wanting to boil everything down to just one number, watch that number. If you want to, get inflation data out of your head, earnings numbers, GDP growth, all of it, jobs numbers out of your head, if you just watch the Treasury yield, generally, again, in exact science, below 4.5%, stocks up, above stocks down, or flat at least.
Yeah, it's a good rule of
Okay,
thumb.
let's move on to our big three items. We'll start with something that's directly related to bond yields, and that is inflation data out this week, both PPI, Producer Price Index, and CPI, Consumer Price Index, out Tuesday, Wednesday. Both came in, the headline numbers came in as expected, which these days sort of qualifies a little bit as a victory. What the market liked was that the core in the CPI number, the core inflation number was it 3.2% where 3.3 was expected. So that was a slight improvement after that had been trending up. And instantly, the market had its best day of the year after that report on Wednesday. It's since pulled back a bit, but I think while I don't think the inflation number was enough to was good enough for the Fed um, to, sort of cease their fretting about inflation spiking again. And I don't think, suddenly it's going to change their calculus for when they're going to cut rates. A lot of people are expecting possibly fourth quarter or even beyond, or sorry, second quarter or even beyond now for the first rate cut this year. Um, but it at least stopped the bleeding and the hand wringing in the market that had sort of taken hold the last month or so.
Yeah, the timing of the inflation report was, I think, really critical because it was coming on the heels of Fed commentary talking about lower expectations for rate cuts this year. The CME FedWatch tool, which sort of measures market participant expectations for rates, was reflecting, I think, closer to two cuts instead of four. The Fed minutes from the December meeting came out and showed that the Fed was worried about Trump's policies being potentially, or I suppose Trump's speculated or proposed policies being potentially inflationary. So the inflation numbers really couldn't have come at a better time. Um, the big numbers that stood out for me, core PPI 0.1% month over month versus 0.3% expected, and
Yeah.
core CPI 0.2% versus 0.3% expected. Because like you said, the headline numbers were pretty close to it. They were as expected. They were improvements from a year ago, but the timing really couldn't have been any better. And
Yeah.
from a technical standpoint, just looking at the charts on like the S&P, we're looking at small caps. We were counter trending from early December, right? Like we've been in a 2 year bull market. We peaked on like December 5th or 6th, and we've been just in a channel trending lower since then. And we were sort of at that threshold of like, oh, is this just going to be another little correction like we had in August or July, or is this maybe going to be a reversal? And now we've perked back up. Everything is rallying. It really does seem like the bull is fully back in effect. I mean, I'll hedge a little bit and say I definitely want to see us close above like 6,000 on the S&P today, and ideally above 6,100 probably next week sometime. But it very much feels like the bull market is going to pick up steam and be back in effect now. And a lot of that
Yeah, you
fell
said you
down.
said to trust early trends. That was one of your resolutions, so I'm going to hold you to it.
Yeah, the timing on
So,
of the inflation numbers and the results couldn't have been better for stock market investors. Now, obviously, we have like a holiday weekend coming up, and we'll get to Trump a little bit later, but a lot of his policies are potentially huge wild cards. So I'm cautious on that front, but everybody in the market seems to really like what they're seeing right now.
Yeah, and just to tie the inflation number with what I was talking about with yield at the top, it was 4.8% prior to Wednesday's data, or sorry, entering the week prior to both PPI and CPI, which was a 14-month high. And there was a lot of worry about it surpassing 5% for the first time. Gosh, it's been a while since it was 5%. But so I mean, it instantly fell from 4.8 to 4.65 and is now down at 4.6. So, that shows you what a life raft these numbers were for the market and for, potentially the inflation fears. Okay, let's move on to number two. Uh, Earnings season, Q4 earnings season is underway. Um, and going to get to earnings hotspots that we have our eye on in just a bit. But a couple banks have reported earnings, and they've been encouraging. I think Brad, you have the data on the couple that have reported thus far.
Yeah, Bank of America reported 82 cents a share in earnings against 77 cents expected on 6.7 billion in profits. Morgan Stanley also reported this week 222 a share against $1.70 a share, and it doubled from the year ago quarter. So really, really solid results from both of them. Um, in both cases, a lot of the beat was attributed to equity markets, to their capital market portfolios. A couple of things that did stand out other than look, Mike calls them bull market stocks like the Morgan Stanleys and Goldmans of the world for a reason. These
Blackstone.
companies, Blackstone, these companies do better in bull markets because their asset prices go higher. People are investing more. Like all that stuff is really good for these companies. Couple of things stood out. The net interest income was a bright spot for Bank of America. So if this is sort of our rate regime for the next couple of years, if they're still doing a good job generating net interest income, that's good news for the banks going forward, at least for the next, year and a half, 2 years until maybe rates come down a little bit more again, or I guess more substantially than 75 basis points or whatever. And then Morgan Stanley did have one weak spot, which was their deal making. So IPO market's still not heating up. M&A activity is still a little bit weak. In a perfect world, you would want to see more strength in that area because that means that companies are feeling bullish. That, if it's a good time to go public, then we're sort of at peak perception of market strength. So it's not perfect, but A pluses all around seems to be where the banks landed.
Yeah, it's a good way to kick off earnings season. An earnings season, I might add, with high expectations, 11.9, I think it's now 11.7% earnings growth from S&P companies for the quarter expected, which would be the highest earnings growth rate since fourth quarter of 2021, so more than 3 years. So expectations are high. So surpassing them, at least the banks, is setting a good tone here. Uh, and, just bank earnings being strong is a signal of economic strength, and, throws more cold water on those who are worried about potential recession. It's just two banks so far, but good start. And a good start, just it sort of helps. It adds to the sort of mini market turnaround this week where there'd been, sort of a rash of bad news for a month plus. And, this week we've had some good things happen for the market.
Yeah, 2025 starting off with a bang.
There we
And
go.
it really feels like it couldn't have come at a better time. Although
Yeah.
I'll have to sometime in the course of this conversation, I'm gonna have to pull the bull bear ratio and see if that backed down the way it had in the last couple of little mini corrections we've had in this bull market. I wouldn't be surprised if it had really pulled back noticeably. I've seen commentary from Goldman that some of their institutional clients have overweighted, have spent the last month overweighting cash. So they've got sort of fresh dry powder that they're willing to, or hopefully that they'll be willing to deploy. But positioning seems really good, and unfortunately, so much is up in the air politically that it it's tough to, it is really tough to try and game out expectations for more than a week or 2 weeks or 6 months at a time. But we shall see.
Yeah. And so speaking of we shall see, by the time we do our next podcast, we will have a new and old president. Trump, his inauguration is on next Monday, the 20th. So when he was elected, there was this initial market fervor, and it seemed like, wow, market really loves the idea of Trump being president, and with good reason. His his first term, uh, stocks did well. Is in his first 4 years in office, S&P was up 63%, which outpaced the last 4 years under Biden, not by a huge margin. Biden is it's in like the low 50s. I don't know. Well, today is literally the last day of the tenure, so we won't know the final number till after that. But that works out to about a 1.3% per month return. 126% return if he'd won re-election, which he now has. So if that had been the case, would have placed him fourth on the list of performance since World War II, just ahead of Ronald Reagan. Now, again, it's just one term, but now he has a second one. So there's reason for excitement. His sort of America First pro-business agenda. But then it seems like in the last few weeks, combined with Fed concerns, although intertwined with Fed concerns about inflation possibly rising again, some of his, trade policies, high tariffs on China and Mexico and elsewhere, has people worried that inflation could come back. So what do you think the reaction will be to when he actually takes office?
All right, so we're already spotty on predictions sometimes.
Yeah.
This one is extra hard because I've seen speculation and commentary that maybe there may be as many as 100 executive orders when he first takes office. Um, Inauguration day is on a market holiday, so it's everything's going to be hitting at the same time. It's going to really be a fire hose. The biggest concerns are tariffs, right? If tariffs are super high and it's a shotgun approach and it's a blanket application, that's probably bad news. If we start locking down immigration or start deporting people immediately, that's also probably bad news. If it is more restrained, which is possible, I don't know, it's tough. It, it's also the richest cabinet in history, right? Like the
Yes.
most affluent, richest people in the planet on the planet are guiding the White House right now. They don't want to crash the markets.
Right.
They don't want to lose money. That's like their divining rod of decision making is what maximizes how much money I have. I do think it'll be more restrained than people are worried about. Um, Bitcoin is one that has had a significant response. There was commentary today that it's going to be a priority for the government, and Bitcoin's up 5% today. It's up 11% in the last week, and that I think still has more room to run. Like if you want to look at a single item that's going to say what's the sentiment or what's the response to Trump's, that one's going to be the most one-to-one because as we've talked about, there's no actual fundamental value to it. So it's entirely sentiment driven and based on what people expect future buyers to do. A lot of the other things are going to be tough. Um, I'm cautiously optimistic that it will be not as bad as feared. I think it'll be bad, but I don't think it'll be a catastrophe.
Yeah, I wonder if having some of those, as you know, some of the richest people in the world surrounding him in his cabinet, um, if that will, those are people who are very highly leveraged to the market, if that will tamper down some of his impulses that could be inflationary with the tariffs. It seems like it already may be to a degree. We won't really know till, starting next week. But yeah, we made it, the first 4 years were were pretty good, as I just cited, under Trump. So yeah, there's good reason to be optimistic that the next four will be too. But yeah, all starts on Monday.
Yeah,
Uh,
I do want to leave a final note with that one though. The things that people are expecting him to be good for tend to matriculate through the market over a longer time horizon, right? Like lower tax rates that boosts investment or that boosts balance sheet cash. That takes longer to play out than the flip side of, let's say, super high tariffs. Like that's an immediate
yep.
impact. So I do think that if there's a negative reaction, we will see it very, very quickly. If there's a positive reaction, I think we're just going to continue the path that we're on right now, which is solid bull market, spreads out sometimes, maybe pulls back when people get sensitive. I did pull the investor intelligence bull bear ratio. That flipped from 4 down to nearly 1. One is, people being
Wow.
effectively terrified and it's a great time to buy. So it really turned on a dime. Um, it's the same thing we've been doing the duration of this whole bull market. We get overheated, we pull back a little bit, and people are ready to start buying again.
Yeah.
Um,
That's as good a buy signal as any, it seems, at least given what's happened, the pattern of the last couple of years. Um, okay, so we'll get to our main segment today on earnings hotspots in just a minute. First, just wanted to mention that for people listening today, we have a special offer for Mike Santolo's Cabot, who was on last week's podcast, Chief Investment Strategist, for his Cabot Top 10 Trader Advisory, which is a weekly newsletter. It gives 10 of the you know, hottest or, stocks with the most momentum every Monday. And that's for 50 weeks out of the year. So 500 stocks per year. We're offering that for half the normal price today. If you go to cabotwealth.com/street, it's just $197 for the whole year. So $197 for 500 stocks. That's, I think if my math is right, it's less than 50 cents per stock, 50 cents per stock. So really good deal. Cabotwealth.com/street. And it's also a 30-day, 100% money back guarantee in case you don't like it. But I would be willing to guess that that won't be the case. Mike is our longer, he's been with Cabot for a quarter century, has won numerous market timing or market timers digest awards. He's great at timing the market and he's great at finding growth stocks. And he gives you 10 of them every single week in Cabot Top 10 Trader. So again, cabotwealth.com/street. Okay, let's move on to our segment. So you called these earnings hotspots. I'll let you sort of take the reins and sort of introducing this.
yeah, so it's the first earnings season of 2025, right? We were coming from a period of weakness, a correction that maybe could have turned into a bear market if inflation numbers didn't land how everybody was hoping. Um, Valuations are super, super stretched. We have talked about that a lot over the last 2 years. The Buffett indicator, right, where he looks at the Wilshire against GDP is overvalued. The Shiller PE ratio, which looks at a 10-year inflation adjusted average earnings against the value of the S&P 500, is super inflated. Individual sectors are inflated. The overall price to earnings ratio of the S&P is inflated, right? Like everything is signaling that the market has been really hot for the last 2 years. Where that's relevant for earnings season is that the best for investors fix for overvalued stocks is really strong earnings because that pulls up your denominator and it makes your ratio smaller. So, given given the situation that we were in coming into Q1 of earnings, there's a lot of potential for things to go wrong, and we're not quite priced to perfection, especially after that little dip that we just had, but we're pretty close to it.
Mhm.
The flip side is like one quarter earnings doesn't make or break a stock. If Nvidia comes out and says, "Hey, we sold 10 less Blackwell GPUs than expected," nobody's going to care. If they say we had to delete our order book because nobody wants to buy chips anymore, that's a different story. But for the most part, one quarter's earnings can't make or break, but the market was in kind of a make or break spot. So what I did, at least with my picks, is I wanted to target some sectors or some companies whose earnings are maybe going to give us a better sense of some of the longer term trends that have been driving the market for the last couple of years, or even on maybe a shorter time horizon. What are some of the companies? What are their individual earnings reports telling us about the broader market and the viability of the bull market to stretch beyond 2 years into three, four, five? So
Yeah, so you want me to give mine first?
yeah, that'd be great.
Okay. Now, the way you described it at the end there, the viability of the bull market, this is a little more niche than that, or less determinant, will probably be less of a determinant of that than some of the ones you're going to give. But mine, electric vehicles, namely Tesla and BYD, the two sort of dominant players right now. Tesla delivers its earnings January 29th, so that's coming up pretty soon. It's just coming off a strong, its first, strong or strong-ish quarter in like a year, which really turned around, that along with Trump being elected, Elon Musk being named to his cabinet. That really helped turn around the stock after, really a year plus, couple of years of sort of flailing, or not flailing, but being a little bit sort of stuck in the mud. It rose to all-time highs, briefly pulled back, and now it's back up again. Um, and but I think, as I've said on here before, you know, there's a lot of theoreticals with Tesla. Musk being in, cabinet, good for Tesla. America First president in a company that does most of its business in manufacturing in America. Good for Tesla. But in the end, it comes down to, at least for now, it comes down to deliveries. It comes down to uh, sales, and it needs to start stockpile a few good quarters here. So that's one, and then BYD is become its biggest challenger, especially in China, where it does 90% of its business. That stock that I've liked because when it transformed from just a car company, cars of all kinds, including transmission. It flipped to all electric, plug-in hybrid and battery electric in 2022, and sales immediately tripled. And it's continued to grow, and it's actually outpaced in terms of EV sales, outpaced Tesla for the first time. I believe it was last quarter. And as it expands globally, just outside of China, they have plants either underway or under construction. They believe in Southeast Asia, parts of Europe, South America, not in America, notably. But so I'm interested to see those. BYDs aren't out until late March. They did give their delivery numbers for the quarter, which were good. Um, so those two I'm really just curious about, and sort of it might tell us the temperature for, especially because Tesla does not have the hybrid aspect that BYD does, and we've talked about how hybrids have sort of uh, stolen the thunder from Tesla and other pure EV companies, which has benefited BYD. And so it'll be interesting to see how the two companies' growth compares in the upcoming quarter.
Well, that's one we haven't touched on yet, but that EV tax credits and the EV infrastructure push that we've seen, that'll be another one that I think is going to be very responsive to some of the some of the Trump initiatives that we run into. Uh, so yeah, I like that one. I think this quarter ends up looking good for all the EV companies, at
Yeah.
least all the domestic ones, because Trump's impending time in office, I think, front loaded a lot of potential EV buys into Q4 that maybe otherwise would have waited. So I don't know. If I had to put money on it, my money is on Tesla beating earnings expectations this quarter.
I agree. Yeah. And we'll find out soon enough. It's January 29th. Okay, what's your first?
So consumer retail generally, the two that I'm paying closest attention to are Target, which doesn't report until March 4th, and Walmart, who reports on March 20th. And the rationale for this is that there's been a lot of discussion around uh, the K-shaped recovery from the pandemic. The economy has done really, really well, but it's been somewhat bifurcated, where in the immediate aftermath of the pandemic, a lot of the spending was coming from lower income consumers who were flush with stimulus cash, who were, putting more charges on credit cards, who were spending on experiences, stuff like that. And then sort of in the last year or two, a lot of that spending has come from higher income consumers who are riding the wave of much higher stock prices, higher housing prices. So I want to get a sense of the strength of the lower end of that K-shaped recovery. Target posted solid holiday numbers, but they didn't raise their outlook. They had lowered that in November, I believe. And then Walmart, they are going to be very representative of what the business community expects the impact of tariffs to be. They report February 20th. That gives them a month for management to devise whatever their commentary is going to be after Trump's first day in office. So if he comes out and says selective Chinese tariffs, it's not going to hit everybody. Walmart commentary may come out and may say, hey, look, collectively as a business community or as a representative of the business community, we're actually not expecting much in the way of impacts from these tariffs. They're really fine-tuned. They're not going to hit the bottom lines. And it's also going to give a sense of the strength of lower end consumers broadly. Target, in their holiday number report, said that they were still seeing deal seeking behavior, which generally it doesn't show weakness, but it shows some precarity for middle income spenders. So those two, and they're 2 weeks apart, but they're going to be my snapshot for how is the middle of the country and the lower bounds of the country, how are they feeling economically? It's sort of a sentiment measure that's not based on a survey.
Yeah, I mean, in terms of measuring the economy, that retail, I knew that was going to on your list, so I deferred to you on that one. But retail is definitely one of the more important and interesting earnings categories for this upcoming cycle. It was fascinating the last quarter, the disparity between, as you mentioned, Target and Walmart, people gravitating more towards Walmart. And we'll see if that trend continues. It will be telling as to the health. I wonder which other retail companies will provide insight into the health of the market. I've been high on companies like Dick's Sporting Goods,
Yeah.
which has been pretty resilient. It did well through COVID, and is really accelerated since then as, things like kids' team sports have returned. So that's one I've been high on. And things
Do-
like Sorry, go ahead.
dollar stores used to be a
Yeah.
decent yardstick for measuring whether people were trading down even from like a Walmart, but that industry has really struggled in the last couple of years. I mean, there was
Yeah.
a lot of horror stories about one employee and milk like getting warm on the floor because they can't stock it into the coolers, and you know, customers effectively like managing inventory because they're they're in food deserts that are understaffed, and all the horror stories around some of the dollar stores have been a drag on them. They used to be a good indicator. I imagine Amazon will probably be that tends to be more of an impulse buy thing. I think if their retail numbers are really strong, then people's routine spending is probably not changing too much. Delivery apps, that's a premium product just based on how they assess fees. I bet that's a good measure. But
Yeah. So okay, that's a good first one. My next, airlines. Airline stocks have really taken off the last 5, 6 months, especially since the August market bottom. The Jets ETF, which is the best way to measure airline stocks, up 37.5% in the last 6 months, outpacing the S&P nearly 4 to 1. S&P's up 10%. So the big boys are leading the charge here. United, American, um, J- JetBlue to a lesser degree, but travel, the it's pretty simple, premise. Travel, I think we're coming off a record travel year uh, for um, for the airlines. Travel is fully recovered from COVID. People are, wanting to get out there, do experiences again. Like yourself, Brad. I know you just booked a trip to where?
Europe,
London,
London,
yeah,
Greece, Crete.
London, Greece, Crete. So there's been a lot of momentum, and I think for given how fast they've run up, I think they're going to need pretty strong earnings beats to keep that momentum going. It's possible even that with that prices may already be baked in, especially with the likes of United and American. But I think while I fully expect earnings to be strong, given sort of the record travel numbers last year, I think it'll be interesting to just see just how strong, and that'll determine whether airlines and travel stocks in general can continue to run up the way they have been.
Airlines are such a, I don't want to say which ones, but I know you've got airlines in, or at least an airline in your portfolio that
Yeah,
has just absolutely killed it.
yeah,
Just like it's the weirdest. I mean, they're basically a utility, right?
hmm
The idea that they are crushing it and that momentum is so strong is amazing to me. I'm looking at, like a 20-year chart on a number of these airlines. This is the best performance, like the best 6 month stretch of performance they've had in 20 years.
right,
Um, it effectively is just a reversal of the COVID break. Um,
yeah.
so it's really remarkable that they've had such strong performance in the last couple of years. I think that's a great pick to
That's
pay
why I'm
attention
curious
to.
to see, how far can this go? Like you mentioned, I do have one, airline stock that I won't give away the name in my value investor portfolio. I had set a price target that was high. I think it was like maybe 40% higher than my, buy price, and it blew past that. And I think it's, gone up another 40, or more than another 40%. Basically it was 40% was my target price, and it's more than doubled in like 8 months. And I'm hanging on to it until the momentum wanes, and I keep expecting it to, and it just hasn't.
Yeah.
Uh, American Airlines um, reports earnings next Thursday. I think that's the first airline to report, Thursday the 23rd. Um, so it'll be really interesting to see. My instincts is that even a really strong beat is probably already priced in, but who knows? I mean, maybe this is really a total, um, you know, correction or a reversal to the mean after, airlines got so beaten up after COVID, during and after COVID.
So I thought Delta might have report. Yeah, Delta reported on January 10th. They reported 15.5 billion in revenue against 14.5 expected. So 6.66% surprise to the upside. Earnings beat by 6%. Um, to put a bow on it, I think what we're seeing with the airlines is what people would typically refer to as a re-rate,
Yeah.
where you look at a sector or an industry and you say, hey, we've been assessing fair value at these at, let's say, 9 times earnings. Um, I don't know how close that is to the actual number. I have not looked. But what's actually fair, given that we're fully beyond the pandemic, is like 12 times earnings. So what ends up happening is you get, for an industry that doesn't move or a sector that doesn't move much, you get a ton of price movement just baked into it because everybody says it's not fair that we're valuing these like we would value like these legacy companies. We should be valuing them based on growth, as if they're growth companies. So I do think we got an industry re-rate that has put us back to sort of pre-pandemic fair value. But yeah, if you bought airlines at any point this year, you're loving it. Good call. Kudos all around.
Yeah, and just to uh, put a little bit of numbers behind, I mentioned it was a strong year for airlines. I think our Cliff Droke wrote today, our editor of our Cabot Turnaround letter, said travel demand reported as strong during the recent holiday season, despite 8% year-on-year increase in airfares. And U.S. Air Force airfares have increased six of the last 7 months. And despite that, record year. So this shows you how strong the demand is. Okay, let's get to your number two.
All right, my second one, I'm going to continue on with the retail theme, but I'm looking at one company in particular. It's Louis Vuitton, Moet Hennessy, LVMUY is the ticker. Um, Luxury retailer, right? They sell Louis Vuitton, Moet, Hennessy. They, so the reason that I'm paying attention to them is it's an extension of the consumer retail. This is the upper bound of the K-shaped recovery, right? The more affluent households, they were doing really well for years based on more affluence in global citizenry, like Chinese citizens, especially becoming more affluent. They're driven by big spenders in the US and in Europe. I want to see if the big spenders are continuing to spend like the good times aren't coming to an end anytime soon. In the first 9 months of 2024, they missed Louis Vuitton, missed on the sale of alcohol and their sales of leather goods. And they only beat, not only, they beat on specialty retail and they beat on cosmetics. So that doesn't serve as a signal that higher income consumers are looking at these good times as unending. It also brings in a couple of other sort of like mega trends that we've looked at: strength of the Chinese economy, how their consumers feel. Alcohol consumption is down among the younger cohort. It's down among millennials, but it's really dropped off a cliff with the younger generations. So like older than my kids who should not be drinking yet, and I assume are not. Um, but if that's a secular change to how people consume alcohol, that's bad news for all booze stocks for generations, or at least for the next generation, right? People are just going to spend less, and that would lead me to think that it's going to grind lower. And then the other factor that I like about Louis Vuitton is it comes with the lipstick indicator, right? Where I think it was Revlon CEO essentially said, "Hey, people when people are cutting their luxury spending, they they'll spend more on lipstick because it's these little luxuries that still make you feel good, like you just bought a nice luxury for yourself, but don't cost as much as a new bag." So Louis Vuitton is going to be really representative of high income spending, of global affluent spending. Is a lipstick indicator in play? And then are alcohol trends sustained, or are they going to be sustained by younger generations, or is this a blip that is going to revert to the mean at some point in the future? So I really like it as sort of a catch-all for a lot of these consumer trends that are in different phases that I've been watching for a while.
It's interesting. You mentioned earlier, how people sort of gravitated more towards Walmart, which is a little lower cost than Target bad quarter, Walmart good quarter, which seems to suggest that, people wanting cheaper deals. But then the dollar stores have been struggling. And, as you're mentioning here, there's, also a gravitational pulse towards some of the higher end stuff. So it's, really hard with all these retail. It's hard to, find an exact narrative of what's going on in retail, which I guess is a microcosm of the economy. There are various times when people say, we might be getting close to recession, and or people say economies, the feeling, mostly due to inflation, was that the economy was not good, but a lot of the data, say otherwise. So it's sort of representative of a or a microcosm of sort of a confusing and at times um, contradictory economy, it seems.
Yeah, the talking points around the election were price of eggs. You and I have
Yes.
not once talked about the price of eggs.
No.
We're talking, yeah, I mean, like we're talking about Louis Vuitton's performance when like that was the dark cloud over everything was how expensive eggs had gotten. Um,
Right.
I mean, I
We'll do an
think
eggs
the
podcast eventually. Yeah.
I think the explanation or my best assessment of an explanation is the middle class is getting hollowed out a little bit. There are some people that are doing much better, and then there are some people that are doing worse, and it's bifurcated, right? It's the
Yep.
K shape, right?
Yep.
Some are going better, and then a lot are doing worse. So you have these conflicting narratives, um, because you have conflicting economic performance from different groups depending on where you are, depending on your income bracket more than anything, and how you have exposure to like assets, right? Like if you're invested, you made 25% last year. If you're working, you may have taken a pay hit because your wages probably didn't grow as fast as inflation.
Right.
And like I don't have a fix for it, but that's the investing backdrop that I have to work with. So I'm doing my
Yep.
best to try and keep a handle on both of those factors.
Right. Okay, let's just quickly go through our last couple. Mine, simple. NVIDIA. It's been the biggest earnings report for a year or two now, since the AI narrative took off. They don't report until late February. Let's see, look at the exact date, February 26th. Last earnings, NVIDIA is a clear victim of its own, massive success where even earnings beats EPS came in at 81 cents versus 75 cents estimated in the last quarter, reported in late November. And that wasn't good enough for the market. And so NVIDIA trading at 147 prior to earnings, now down to 138 a share, although it's back up, it bottomed not long after earnings, below 130 is 128 a share. Um, so the bar is extremely high. Nvidia is going to have to wow people to. I think Apple maybe a decade or so ago fell into this trap. Tesla too, where they set the bar so high that victim of their own success. And in Nvidia's case, it's has such influence over the market and wide swaths of the market, AI in particular, that there's a lot of pressure on them to really deliver. And while they, you know, for the average company are delivering, well beyond average, it's just not what it was. So we'll see if that trend continues, and how if it's just you're a similar beat to what we had last quarter. If A, that's not good enough for the stock, and B, if it's not good enough for the market. I mean, not maybe not a total coincidence. Probably more coincidence than not. Maybe not a total coincidence that since Nvidia's earnings report, not only is the stock down, but so is the market.
Yeah, I do wonder with Nvidia, it's a $3.4 trillion company right now. I wonder if there's a number that they could put out there that would be so astronomical that it would convince people to add even more exposure to
Yeah.
Nvidia. Um,
I guess the
but
argument is that the stock is basically flat in the last since the start of October.
yeah,
I mean, actually, if you even go back to the August highs, got up to 130 a share. It's not that much higher. It's 138 right now. Not that much higher than that. For but that also comes on the heels of it, you know, more than doubling year before, tripling. And it's up 2,000 over 2,000% in the last 5 years. So it's doing just fine. But this is one of the more extended breathers it's been on, in the last few years.
yeah. Um, I don't know. I think like I'm not betting against Nvidia, but it feels like maybe more of a sell the news kind of event. It definitely seems topped out. Although I said it seemed topped out a year ago, and I was
Right.
very, very wrong about that. So I'll continue to risk that sort of reputational hit by saying it seems topped out. Like how much more money can you throw at it? But I do think it's really important because so much of the bull market is built around that entire ecosystem. And as long as the mega cap tech companies are spending money on infrastructure, it's good for nuclear, it's good for natural gas, it's good for utilities, it's good for chip manufacturers, it's good for silicon processors, it's good for software. Like it's good for everybody. And Nvidia is like the linchpin of it all.
Right.
So I agree with you 100% that it's always going to be important.
Right.
Uh, I'm
Yeah.
just I wonder if there's a number where if they beat that, there's another leg up.
Yeah.
That's the thing that I'm suspect of.
And that flipped what in the last 2 quarters where Nvidia reporting earnings was there. It only did deliver, you know, returns that wowed enough for the market to take off, and the stock to take off. The last couple quarters, it's been sort of the reverse, where Nvidia earnings. I'll put it this way: that Nvidia is the only company these days really that gets mentioned as this is an event coming up, a potential market moving
Yeah.
event coming up on par with, or close to on par with, the latest Fed announcement or inflation report or whatever. Um, okay, let's go on to your last one.
All right. My last one is insurance companies. Broadly, I don't have any in particular that stand out, but the rationale for it is mostly news and politics driven. President Trump has, or President-elect Trump for the next couple of days has said he's going to come in and they're going to knock out the middleman with healthcare insurance, right? So pharmacy benefit managers, these sort of rent seekers that live in the health insurance food chain but don't really provide any value.
Yep.
Um, at the same time, the wildfires in LA are estimated to cost in excess of $250 billion right now. I think it makes it the most expensive natural disaster of all time. I'm not positive on that, but I believe it's at that threshold. Certainly the
Yep.
most expensive this year, and that's continue to get more and more expensive. We've already seen insurers pull out of California because of fire risk. We've seen them pull out of Florida because of flooding risk and hurricane risk. All of these things sort of combine to put a spotlight on insurance as an industry. Um, it is an industry that is, I think, more susceptible to disruption from regulatory intervention, even under Republicans, or from artificial intelligence. Insurance is ultimately looking at a big data set and then trying to make predictions for how long somebody's going to live, the risk of a house burning down based on the big data set. AI does that really, 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 really well. As critical as I am of AI and some of the um, vaporware elements that are out there, this is a thing that AI does really well. I think insurance is really primed for disruption, and I think this quarter earnings can maybe tell us how much their leadership as an industry is looking at what a lot of consumers are looking at. United Healthcare obviously had their tragedy with their insurance unit CEO. Um, I want to know if insurance companies are responding to public pressure and these highly visible risks by maybe taking a hit to profitability, right? We talked about re-rating airlines earlier. There is the re-rate potential for insurance companies. Insurance companies could provide better service, better coverage at probably more affordable costs. They could pull out of markets. They could stop using lower cost property markets like in Oklahoma or uh, Missouri or something like that to finance higher cost markets in California if it's a big multinational. Um, so I think that they're sort of the most susceptible to a major re-rate and to a reassessment of how valuable they are and even how they do business. Are they going to be continue to be big dividend payers? Is that feasible for them, or do they need to be more nimble? So that's one where I'm most interested to see what the senior leaders at these companies are seeing in the public discourse and how they're responding to it, and whether it might actually bring about some wholesale changes to the industry as a whole. It could change the role that these insurance companies play in individual portfolios.
I think that's all very reasonable and makes sense. I have no notes. And we also run pretty long today. So I think that's the podcast. What do you think?
Yeah, yeah, I
Yeah,
agree.
giving you six earnings hotspots to look out for. So look out for them. And we didn't, none of them included the banks, which are underway and have gotten off to a good start, as we mentioned. Okay, as always, thanks for joining us on Street Check. Like and subscribe wherever you get your podcasts, or if you're watching on YouTube, 5-star ratings, those are also good. But we will see you again next week.